Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of July 27th, 2025. And in this week's episode, it's just myself, Sprocket888, and I am getting ready for the big green earnings wave. So earnings season is just about ready. It actually already started kicking off with a week under the belt so far, and the wave of earnings is coming. We will approach weeks where there will be hundreds and hundreds of companies announcing earnings. And earnings are one of my favorite ways to trade the market. So this episode, I'm going to do a refresher on the conditions that I am looking for when I decide whether or not to participate in an earnings trade. And we'll go through one upcoming this coming week. But before I hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you can find the link to thetagang.com/sprocket888 as well as /ViperXL007, where Viper and I post each and every one of our equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find us there, let us know and we will get it there. But let's hop to this week's content. And it's going to be a relatively quick episode this week because we are going to do just a very quick refresher on my absolute favorite earnings trade coming into earnings. And so before I hop over to my screener and talk through all of the parameters and values that I'm really looking at when it comes to screening the trades, I'll give you a really high level of what it is that I approach. So when it comes to earnings, my favorite trade is a strangle. And what a strangle is selling premium. And you're selling both premium on the call side and you're selling premium on the put side. And what you're effectively doing is saying, I believe that the volatility is so great that it is over anticipated what the actual movement of the stock is going to be. And so I pick a high side and a low side. And I say, this stock is going to stay somewhere in this range. And as long as it stays within that range, that time decay and volatility decay will fall off of that stock, off of those options, and I will be able to buy them back to close for a profit. So what I do is I sell this premium prior to the earnings announcement and then post the earnings announcement as the volatility contraction comes in, because that's what earnings is all about. That's what volatility is about. Volatility is the uncertainty in the market. How much of an expected move is there? And we don't know. And that's what is kind of building that volatility. And then as soon as the earnings announcement is out, the unknown is then known and there is no more uncertainty. So the actual pricing then will kind of come down and that volatility will start to contract. And basically selling options premium is largely made up of that volatility factor. So the less volatile the option, the less premium that is in the option. So I sell the option when the premium is high in an effort to capture that volatility contraction. And so as that volatility contracts, I will then buy it back, hopefully at a lower cost. And the other thing that is working with me is time decay. So the other big part of an option is how much time is left on the coupon. So the more time, the more premium. But as I sell, time goes by, so that premium bleeds off. So I'm really playing for two contractions. I'm playing for the contraction of time premium, and I'm playing for the contraction of volatility. So where do I put these strikes on the high side and the low side, and what determines where those are? So the factor that I use for that marker of the high side and the low side is a thing called delta. And delta is the expected move, basically, or the probability that something's going to fall at a certain percent. It also kind of stands for the percentage of movement attributed to a whole dollar. So a 20 delta would be a 20% representation of a full movement of a dollar. So if the underlying were to move a dollar, a 20 delta option would move by 20 cents. And when I go in there, the other way you can look at that is there is a 20% chance that that option will finish in the money. So it's really kind of a probability. It's also trades relative to the underlying price at a discount, depending on where that strike is. So what do I look for in an earnings? Provided that the volatility is elevated, I'm really looking at somewhere between a 16 and 20 delta strike. So a 16 delta is approximately a 1 standard deviation move. So I will look and probably start around the 16 delta, but most of the time I'll kind of pull it up depending on where the strike numbers are. Up to about a 20 delta is kind of the high side of where I'll go on a delta. And because I'm going on that low side and the high side, I'm kind of narrowing my area of profitability, or probability of winning, I should say. And so if I put a 20 delta on the put side and a 20 delta on the call side, what I'm really looking at is basically there is a 20% chance that it will finish out of the or in the money on the put side, or a 20% chance on the call side. So I effectively have about a 60% chance of winning. Now, I believe that is tipped a little bit in the favors in my court because of that elevated premium. Because a lot of times when you get the elevated premium relative to where it has historically been, often that pricing is overestimating the volatility. So you kind of get an extra crush and it never actually reaches that expected move. Of course it can. And that's why when you enter these trades, particularly with no protection legs, you need to be okay with assignment, because that's what can happen if you close out the week in the money. Is you can be assigned either long those shares if you sold the put, or short those shares if you sold the call. So you still have the opportunity to roll, which I will do if I get into a bind. But going into any earnings trade, I have to be okay with that assignment. Now, most of the time I am. And why am I okay with that assignment? Because already we're dealing with extremes. So we're already dealing with a really elevated volatility extreme. So even if I get assigned at those strikes, that's already an extreme level of price. So even if the volatility if the volatility were to reach it, which probabilistically, historically, it doesn't actually stretch that far in many cases, then if it does, now how likely is it that the price is going to stay there over time? So there is always a reversion to the mean in the market, whether that is an RSI oscillator, whether that's a volatility round, whether that's a price. Any sort of major move in the market often has a component of elasticity to it and a reversion to the mean. Maybe just momentarily, but there's still a reversion to the mean. And so that's why if we drop way high or way low on the put side and I get assigned, I'm okay, because there's still that reversion to the mean that often happens in the market. And so it can pull that stock up. Now, maybe that stock's going to continue lower, but I'm looking for that pull back up, reversion to the mean. On a high side, same thing. So let's go ahead and take a look at how do I actually screen for these things. And we're going to flip over here to my screener, and I am screening in my brokerage of Thinkorswim. Now, my everyday brokerage of trading is actually Interactive Brokers, but I'm just super comfortable with the Thinkorswim screener. So I actually screen my plays in Thinkorswim, but I enter all my trades in Interactive Broker. So right here is my saved criteria. Now, some of these parameters I don't actually use anymore, but I do keep them here just in case I want to use them or throw them in there. So the very first one I do use. So this is the closing price. What is the closing price of the underlying stock? Now, what I have found is, for me, I need at least a $20 underlying. If you get much below that, the options premium is kind of small. It's kind of not worth it. I'm just not interested in it in my position sizing. For your portfolio, it might make sense to go lower, but a lot of times I'm targeting an underlying price somewhere in the $50 to $300 range. I have a pretty wide range that I can play. Now, I don't bother limiting the upside because who knows how it's going to pan out. So I just limit the bottom side, because below $20, I don't even want to touch it. So that's the first screener that I put out is what's the underlying price? If it's $20 or greater, okay, I'll take a look at it. The next thing I do, this is the volatility or spot volatility. So this has nothing to do about where it has been historically. This is just right now, what's the volatility of the underlying? And I have found that usually a spot volatility of 30 to 40% is about a minimum for what I want to go after on premium. Now, you can have a spot volatility at 25% and it be in the 100th percentile of volatility for that stock. That might be something that just doesn't move much, maybe a utility, maybe a railroad, something like that. In those things, they typically have lower spot volatility, maybe in the single digits, maybe in the early double digits. And so if you get a 25 or 30% spot volatility, that's about double what it normally is. But I find that unless that spot volatility is at least 35%, it's not really worth it. Now, you'll notice that a lot of what I end up taking are usually in the 80 to 120% or more volatility, spot volatility. Typically, if you get into the 100%, like over 100, you're really probably talking about pharma or something that's crazy going to move. Now, I will sell some of those at times, but I get cautious much above 130, 150% volatility. So the next metric here is IV percentile. Now, this is one of the ones where sometimes I'll put it on and sometimes I'll set it so that it doesn't matter. Right now, I'm saying I'm going to set it so it doesn't matter because there's not a ton of earnings trades out there. So I'm okay to fill up the screener with extra numbers. What I will do is I will sort by the IV percentile. So I will not filter here, but it is in my screener if I choose to use it. Now, the next one down is where I really decide, okay, how far out in earnings am I going to look? And what I typically do, my typical pattern is I will screen on usually a Saturday or a Sunday before the upcoming week. So I will set this to has earnings anytime in the next 5 bars. Now, the bars here are actually set to 1 day. If I scroll over, that's what the bar is. It's 1 day. And so that means, do you have earnings in the next 5 days? And that's how I look because that's the upcoming week. And what I'll do is I'll pick out the ones I want to trade. I'll put the trades on Monday, no matter when the earnings are, put them on Monday and kind of watch them throughout the week. And I'll close out just after earnings. And if they're not where I need them to be, I'll hang on up till basically that Friday. And then on Friday, I'll either take assignment, which is rare, but I almost always will roll unless I was early assigned. The next one down is average volume. So this is a big component of liquidity. And so I basically say, look, show me only shares that are trading over 1 million shares of stock a day. Now, I prefer several million, but when I'm casting a wider net, I'll leave it at 1 million. If I want to tighten that net up for the higher volume things, I will raise that number to a higher volume. But because there's not that many names right now, I'm okay to leave it at 1 million. And that's 1 million averaged over 5 trading days. You can change that average on what you're looking at because that will, sometimes you'll get these crazy meme stocks, which will have really high volume in that last 5 days. But historically, the volume's not very good. You want to try to avoid that because you can get into an illiquid situation and your fills won't be as good, and that will cost you profit. Now, the last one is basically if I wanted to put a top end cap at things. So I could say has earnings in the next 5 days, but not greater than, 2 days. So if I wanted to kind of push that out, I can say in the next 5 days, but not sooner than the next 2 days or something like that to drop some of that off. Right now, it's just next 5 days. So this last value is not actually used. And then I run the screener, and here's what you got. So you got this number over here, which if you can read it, it's kind of small. It says there are 58 stocks that match my criteria. So the next thing I do is I come to the columns, and I have different columns, but the one that I really like to screen out on this is this IV percentile. So that's this column right here, and I will sort by that IV percentile. And I'm looking for basically anything over 60%. because this is a number that's usually between 0 and 100. This basically says over the past 52 weeks, in what percentile is that volatility relative to itself. So this very first one, First Bancorp, has a 95% IV percentile. That means in the past year, 95% of the time, volatility has been lower than it is right now. And that's what I'm looking for, that elevated volatility. So I'm looking for those higher IV percentiles. And what I'll kind of do is I'll simultaneously look at volume and I'll look at the name of the stock to see, do I recognize any of these things and do I want to trade them? And one of the things I'll point out, notice how quickly this drops off. So there are 58 names here, but the majority of the names on this list are really less than 50% volatility. So this is 54. I don't know how far down the list this actually will show you, so I'll kind of keep scrolling it up. So we got 54 here, and then we get 49. So right here is 50. So there's only maybe about less than a dozen that have a volatility higher than 50. There's a whole bunch of other ones here. They go all the way down to, you won't be able to see it on the screen because it's down below, but 2% IV percentile. And that's really tiny. So I'll just focus at the top end of this list. I'll look at volume to see what are the big hitters. All these are about 1 million to 6 million. The 6 million is going to catch my eye here because that's the highest volume in here. So likely that means best liquidity. The other thing I'm going to kind of look at is this column of implied volatility is the current spot volatility. So this is super interesting, 138% spot volatility. That's usually very tempting because it's also in the 85th percentile. So Viking Therapeutics, no idea what they do, but if I take a look at them, I'm probably not trading this because I just don't trade pharma. And this looks to me like a pharma trade. So I'm not going to touch that. Really, the one that's going to jump out to me is this ENPH, end phase. So this is the one that we're going to drill into. It is got the highest volume. It's got a very nice spot volatility of 88%, and it's sitting at 71% IV percentile. So what I'm going to do is I have these number 1 and number 2, just something I set up in this brokerage. So when I click on number 2, it sends this ticker to a bunch of other windows, so I can pull up other things about it. So I'm going to transition over here to the option chain of end phase energy, and I'll show you what I really like about this. So week of expiration that I'm looking at is the expiration of July 25th. It's at 113% spot volatility. Awesome. Love that. But where does it kind of normally trade? So if I kind of come out here into the future to look at the other spot volatilities, about 75% most of the time. Wonderful. This is really showing an elevated volatility here on this particular expiration of the week. So I'm going to expand that. This is 8 days to expiration at the time of this recording. And this is where I'm going to go ahead and probably take a look. Now, what I would do is I would just put, if this is going to pass my inspection here. So let's see if it does that. So I'm looking at the delta column here, 3, 3, 6, 8, 11, 15, 19, 24. Okay, so where are we at? About 15 delta, 16 delta, 33. That's going to give us about $52, $53. 34 is going to pull us up into the 70s here. I'm going to probably go ahead and drop in a put here at the 19 delta. And let's go over here to the call side, looking at the delta. Let's get down to the 16, 20 delta. Okay, so we got a 45.50, a 46, which is a 17 delta. And one of the things that I did look at on end phase is where is it at chart wise? What's the price action? And this price action is down, down, down. It is in a very bearish trend. So I am comfortable kind of pulling up to this 45 strike. I never really liked the 50-cent strikes. The reason I don't like them is because a lot of times when you get the strange numbers, I always love the ones that end in a 5 because those are always available to roll to. If you start looking at monthly expirations and things like that, which is where I end up rolling to, sometimes strikes don't exist. 50-cent strikes almost never exist. Dollar strikes sometimes do, sometimes don't. So right here, 45, I'm going to take 45. Now it's a 21 delta, which is a little bit higher than I normally take, but the chart is relatively bearish. So I'm okay. And I'm going to add this strike to this option that I'm selling down here, which effectively makes a strangle. And so together, one contract is going to collect me about $1.42 in premium. And you got to multiply that by 100, so that's $142. And what I am putting up in buying power is a little over $500. And I really, really like this balance because we're really kind of sitting around a 25% return that really shows elevated volatility. And let me flip over here to the P&L chart on this to let you take a look at that. So this, the way you read this chart is much like the x-axis down here is price. And this blue line is basically what the trade will make at expiration based on the price. So if it's at $38, this thing's going to bring in $142 at expiration. If it's at $35, it's going to bring in $142. If it's at $44, it's going to bring in $142. So really all of these in this flat part is where it's going to bring in. That's what I like. So look at how wide this range is. So these dotted lines are 10% moves. So a 10% move to the upside will take you to 41.60. A 10% move to the downside is going to take you down here to 34.87. Both of these things are comfortably within inside the strikes. Additionally, they are well inside the break-even points, which is 32.55 on the low side and 46.45 on the high side. This gray bar in the middle, kind of gray period, that is a 1 standard deviation move. So you can see that the 1 standard deviation move based on this volatility is greater than a 10% swing. Either way, all of these things really line up to I would take this trade. So what I would do at this point is I would just jot down ENPH is a trade that I'm going to take. Now, I don't pick the strikes or anything now because when the market opens on Monday, the price could move and I'm going to want different strikes. So I will go through that exercise of picking the strikes on Monday morning after the market opens to see where they are. A lot of times they'll end up pretty much being the same strike, but if there's a big weekend news or things like that, it might kind of push ENPH one way or another, and that is what I'm going to do when I enter it. Now, the last piece that I want to bring up is what I refer to as the Flappy Bird chart. And so let's roll over here to a chart of ENPH. This is the Flappy Bird chart, but the one thing I want to kind of show you before that is let's step out here to 1-day candles, which will give you a real nice view of where the heck is ENPH been lately. And look at that very, very, very bearish trend. So ENPH was all the way up here once upon a time in 22 at around $333. And look how the mighty has fallen. So we're going to kind of zoom in here to where we are today on this. All right, so we're zoomed in here. Now, this red box is representative of how long the trade would be active. So it's not very long. This is the expiration at the end of this. This would be the call strike on the high side. This would be the put strike on the low side. So we want to go hey diddle diddle right down the middle and look at how cavernous this is from a Flappy. This is like level 1 Flappy Bird right here. Yes, look at how volatile these swings can be. So it's possible we can get a big move, but look what happened both times when we swung. We dropped way down here on this swing, and what did we have? We had a reversion to the mean. Then what happened? We slammed down again. But what happened? A reversion to the mean. So what's going to happen here? I don't know. But this gives a lot of margin of error and a lot of probability of being able to land something that might either not make it quite there, or if it does, the probability of being a reversion to the mean. And this is really, really what I love about this chart and this play. This is the definition of elevated volatility. That elevated volatility, because it's so uncertain, it really pushes the delta way, way, way out from that center at the money mark. Like I said, like I showed you, the percentage move of where those strikes are was greater than a 10% move in both directions. And this is exactly my earnings trade. Is going into earnings, I sell this premium the day after earnings. I look for that volatility contraction, that price thing. I close it out. It's a very quick trade, almost instant gratification. And then you can turn around and cycle that money to the earnings trades the next day or the next week. Because once you get into earnings season, it's just bang, bang, bang. All these trades each week. So I only do the trades for that particular week. Now, occasionally I will breach and I will need to roll, and that ties up the capital. But the idea here is that I keep my position sizing relatively small. So most of these trades are somewhere in the 1 to 2% of my entire portfolio value. And that allows me to kind of lay them out, lay them out, lay them out. So in this particular trade, I'm only putting up about $500 where I can kind of pull in $140. And if I can do that quick turn again and again and again, and it has a very high probability of winning, it's basically the similarities to playing baseball, where you're just hitting single after single after single. And all those singles will help add up all the runs on your team, versus waiting and waiting and waiting for that grand slam that may or may not come. So that brings us to the end of this week's episode. Again, just a refresher on my favorite earning strategies. There's other things that I do in earnings. Sometimes I sell just a put. I never really sell just a call. Sometimes based on the size, I'll add protection legs. But the fundamental move that I'm making is selling premium, looking for volatility and theta decay. And the strangle is just my favorite thing to trade those with, because you get to go on both sides. Earnings are a coin flip. You never know if they're going to go up. You never know if they're going to go down. So go ahead and play both sides, push it out statistically, put the odds in your favor. But the key to this is only enter things that are liquid and elevated volatility. Like you said, like I showed you, there was over 58 tickers on that screener. Less than a dozen actually had elevated volatility. And then looking through the 6 or 7 names that were there, ENPH was really the only thing that said, yep, this is the one for me. So out of 58 trades, only one of them is what I'm going to take for earnings coming in there. Now, when we get a little bit more earnings, it gets a little bit nicer, because, you'll have 400 and 500 companies reporting. And then that ratio usually stays pretty consistent about which ones to play. But that's going to give you a nice set of 20 to 30 earnings trades to potentially pick from. So hopefully you found this informative. I know we've covered it before, but maybe you're a first-time viewer. So thanks for watching. Good luck out there. Have fun. And remember, think outside the block.